If you buy a McMansion, you will financially be never independent in life. Life is over. You are chained to that job. You will be slave to your boss all your life. Alright guys, welcome back to the Honda Show. So today I'm going to do a video about how to select a property for your real estate investing. On this channel, my aim is to provide you all the information that you need for investing real estate as I go about investing, all the learnings that I have, and I read a lot, I listen to a lot of stuff. So everything that I think is important to you, I would be presenting on this channel so you can learn from me, from my mistakes, from my experiences. And you don't have to buy all those courses that a bunch of people sell and waste your money, because most of them are not worth anything anyways. You just waste your money on them when you're new, and you should not be doing that. You need to save every penny because you can use that money then towards your down payment and get started instead of just spending money on courses. All right, so let's get down to business. Let me tell you about how to select a property or how to select an area today for your real estate investing. Today, we'll focus on that. So today's video, I've divided this into 7 parts, which will tell you about how much returns you should expect, what areas to go looking for properties, so you don't waste your time and you're not scatterbrained, you're not comparing chalk and cheese. You need to always be comparing apples to apples, so you have a fair assessment of what you're buying and if it's worth your money and your time. Point 1 is always invest in your local area. If you're working in a big city where the cap rates are really low, so if your cap rates are 3% and you're paying 4% for interest rates, I would not be comfortable buying that property. I would try to find something an hour away, hour and a half away. I would try to zero in on an area with acceptable cap rates. You need to have 3 or 4% difference between your cap rates and your interest rates. So say investment property interest rates today are 4%, you should be buying property which gives you a cap rate of 6, 7%, 8%. If you're buying property that gives you a cap rate of 3% and your interest rate is 4%, that is not a good situation. You will not make money in that situation unless something drastic happens, like Amazon suddenly moves and you have a lot of very high paying employees out there, and it just happens. But if you're very serious about real estate, I would even encourage you to move. If your job lets you do that, get a job in an area with a good cap rate. If you're already living there, nothing like it. 30 minutes drive, 40 minutes drive. You should always buy your property locally, because you make your connections locally with your real estate agent, with your electrician, plumbers, HVAC technicians, all kinds of people, your roofers. And if you're constantly changing your geographical area, you have to find new people all the time, and they might take money from you, not do a good job. You don't get a time to judge them. You have to reinvent your team all the time. That's not a good situation. So focus on an area and try to be local. Investing locally is also important because real estate investing is a very local business. Look at Donald Trump. He's big in Miami, he's big in New York. He's not big in Houston, he's not big in San Francisco, he's not big in LA, he's not big in London. That's how it is. Real estate business, no matter how big you grow, most people stay local because you need a lot of connections, you need people. You have to stay local because the values can change from one street to the next. And if you're local, you know exactly what part of town has what kind of real estate values. So when you see a deal, you know it's a deal. You know what parts are low in crime, good school districts, which you would have very little clue about if you travel 200 miles from where you are or go to a different state. Don't do it. Point 2, out of the deal. When you are new to real estate, it is very important that you only buy properties which has cosmetic issues. What do I mean by cosmetic issues? Put some paint on, put some floor on, maybe new vanity, light fixtures, that's it. Anything more than that, you're asking for trouble. Try to stay away from properties which have issues with foundation, illegal additions, sewer and septic issues, issues with lot lines. You need to have these things in place because they can give you a lot of trouble and cost you a lot of money. Just don't do it. Stick to properties which have cosmetic issues, especially when you're new. For the first few properties, people, when they are trying to look for investments, they are trying to find home runs. They're trying to find deals in which they do one deal and that's it. They don't have to work no more all their lives. It doesn't work like that, because trust me, you're not that smart. There are a lot of smart people in this world and everybody's looking for that deal. It won't come to you very easy. You might once in a while get lucky and those deals come to you, but it's not going to be every day, every deal, and most likely it's not going to be your first deal. So if you find a property which after you tackle the cosmetic issues is about 20% cheaper than other properties, 10 to 20% cheaper than the other properties, go for it. Don't think about it, because that's a fair deal and you will make acceptable returns on that property. My strong suggestion to everybody who's starting out: don't buy a single family house if you can avoid it. If you have areas around where you live where you have a duplex, triplex, quadruplex, go for that. And if you can afford that, go for that. Those are much easier to manage. They give you good returns. The apartments or the units themselves are cheaper than buying single family homes. Whatever real estate you're going for, if it's not part of a HOA or not part of a condo association, I would want at least 12% cash on cash return after the 25% that I pay down, because you need a lot of money for maintenance and other issues that crop up. If you're making less than 10% cash on cash, you are probably going to lose money. If you're part of a HOA association or a condo association, a townhouse association, where the outside, that is siding, roof, all the garden work, cutting your lawn, cleaning, everything is taken care of by the association, 5% cash on cash, I think, is acceptable return. If you can get that, go for it. And it's actually a really good place for most people to start, because people are very busy with their jobs. They don't have time running around making sure the property is clean, or handling issues with roof and siding. If you can get into one of these associations where you're getting 5% cash on cash and the house is getting paid by the tenant, it's not a bad deal. Go for it. Money seems little, but as the life goes by, you will accumulate enough equity in the house and you will do pretty good. Point 3, put your 25% down. There are a lot of YouTubers out there who talk about, getting properties with 0% down or nothing down, or burst strategy and this and that. It sounds good, but those deals are not available today. Those deals were available between 2010, 2012. Market keeps changing. You cannot expect what you had in history to be available today. In psychology, this behavior is called anchoring. So you have experienced recently something in the past and you expect the same thing again. It doesn't happen like that. In economics, in investing, you need to change as times change. So in today's times, you're not going to find those deals. Strong suggestion: if you're going to live in a property yourself, put 5% down, 6% down, get a FHA loan, and that's okay. You can live there for a few years and then rent it out when you move out of there, which you can do every year. But if it's an investment property, 25% down is the minimum and you need to save money. Charlie Munger says the first $100,000 is very important. For the first $100,000, you need to save like crazy. You need to work really, really hard, long hours, save every dime. After that, your life will be a little bit better. But the first $100,000, you need to go for it as if your life depends on it. After you put your 25% down, it is very important that your property cash flows. Cash flow is very important because when the economy turns south, you can lose your job, your business can suffer. But if the property is not dependent on you, it cash flows, it'll be all right. You just have to take care of yourself. But if the property is dependent on you, even if you have to pay like $500 towards the mortgage, and now you don't have that $500, you are in deep trouble. Either you're going to lose that property to foreclosure, or you'll have to sell that property at a substantial discount. You don't want to be in that situation. So make sure whatever property you buy, it cash flows. It is independent of you. It should not be financially dependent on you. In fact, I would go as far as to say cash flow is what you should count on as your return on your investment and the equity pay down. Any appreciation that you get is cherry on top. You should not depend on it. When you're looking for property, try to look for a property in an area that's improving, say an area that's going from C to B or B to B plus. That will give you appreciation. But remember, cash flow is of prime importance. Point 4, management. Another reason buying properties locally is very important is you can manage it yourselves. When you are small, when you just have 1 or 2 properties, you're just starting out, even the $100 that you pay to the management company every month adds up. You want to save that money for your next property. Also, managing your own property makes you learn so much. You hang out with a plumber, electrician, HVAC guy, roofing guy, landscaper. You learn a lot. You learn the costs associated with fixing up properties, and it improves your assessment skills. Next time you go out there to buy a property, you know what to look for, how much things will cost. So it just improves your skills. So I think you should manage your own properties till you reach a point where you just don't have the time, and then maybe you can have a management team. In case you have a job right now or you have a small business that keeps you very, very busy and you're just tied down to it, I would say buying a townhome in a HOA or a condo is not a bad deal. you can get acceptable returns compared to interest rates, and you are not really going to be doing much about those properties. Point 5. Apples to apples comparison. I have personally met people who are out there to buy property for personal consumption or for investments, and they are going to 20 different towns and buying or looking at properties from 1 bedroom to 2 bedroom to 3 bedroom, duplex, fourplex, everything in between. You're not going to be able to assess anything. It will only confuse you. So niche down. Like I have, since I've come to New Jersey, I've tried to buy 3 bedroom apartments or 3 bedroom units. 3 bedroom units, families usually like them. You know, if you have 2 kids, mom and dad, 3 bedroom is good enough for you. Families like them, they stay there longer. I get good quality tenants. So I focus on 3 bedroom. It's a much easier comparison. Try to make sure you are comparing properties in the same demographic area. So if you're in a lower middle class part, make sure you compare the 3 bedroom to a lower middle class part, not to a rich part or to a poor part, because that's going to distort everything and it's not going to tell you anything. So make sure your comparisons are valid, they're fair. Apples to apples. If you're looking at 3 bedrooms, look only at 3 bedrooms. When you start out initially, strong recommendation, do not go for commercial property right off the bat. Go for a few residential properties, get your feet wet, get that cash flow coming in. When you are financially very secure, you know much more about real estate industry, you understand about small businesses, that's when you need to maybe get into commercial property. But don't get into it right away. It's a much harder assessment. Point 6, property grade A, B, C, D. If you have listened to my lecture, I keep talking about A grade property, B grade, C grade, D grade property. Even in this lecture, I talk about here and there about property that's grade A or grade B or C or D. If you listen to a lot of other YouTubers, they will use similar terms. I'm not going to get into what is a grade property, what is a B grade property, what is a C grade, D grade, because there is some overlap compared to the demographic of the area. So sometimes rich parts, you would call them A grade properties, sometimes brand new properties, depending upon what part of the country you're talking about. Sometimes brand new properties are called A grade properties. So you can have a brand new property in a D area. I would consider that a D property, even if it's brand new. I look at demographics more. So people, what kind of people live there, what kind of incomes they have, what kind of jobs they have. So A area would be the rich part of town. B and C would be the middle class, lower middle class part of town. And D would be the really poor part of town. In A neighborhoods, usually it's very hard to make money. Your cash flow is very little. The properties are much nicer. Because it is such a stabilized area, you don't really make much cash on cash return in A neighborhoods. And D neighborhoods, frankly speaking, I think you should stay away from them, because unless you are a certain type of person who can handle crime, rough people, unemployed people, it's going to be a hard situation. On paper, a lot of times you will see that D neighborhoods you're making 10 cap, 11 cap, but that's just on paper. You can lose a lot of money on evictions. You can lose a lot of money by increased maintenance costs or people not paying you rent just in case they lose their jobs, because the kind of people who live in D neighborhoods, they tend to have unsteady incomes. They can lose their jobs pretty fast. So I try to be away from D neighborhoods. But hey, if you have a sense of adventure, you can actually make a lot of money. Those areas will actually give you the best returns because you have less competition. Not many people want to deal in those areas. My sweet spot is B and C neighborhoods, so middle class, lower middle class neighborhoods. In these neighborhoods, you will find acceptable properties. You will get deals here and there if you wait. If you have patience. And the people who live here, or even the kind of tenants that you attract in these neighborhoods, have steady jobs. They have credit scores upwards of 700 points, which is great. You have nice tenant base, no crime, you get deals once in a while. What's not to like about B and C? So I like to stick with B and C, and my recommendation to most people would be to stick with B and C. Don't go to A neighborhoods and don't go to D neighborhoods. Point 7, returns. When you're looking for a property in a certain area, the first thing you want to know is what is the rental income in that area compared to the property values. In my part of New Jersey, you can get properties, you can get investment properties 10 times your yearly income. So if a property gives you $20,000 for the year, this is gross numbers. This is before all your expenses. you can get that property for about $200,000, which is an acceptable number for today. When you buy a condo or a townhome in an HOA, you can bump up those multiples to 12 or 13 times your annual income, because those properties are much nicer. You have a nice roof and you're not responsible for that roof. Even if the roof is not nice, the HOA changes it. Those calculations get baked into the property value. So 12, 13 times your annual income, that's a fair comparison. I personally use realtor.com to see where the rents are, how many properties are in the market when I list something. If there are too many properties that I'm competing against that are in the market, I know maybe I have to give a $100 discount to those properties. Or if there are very few properties, I still like to give a $50 discount. So my strategy always is I give the best product and a little bit cheaper. That way I attract good people, good talent, because good people, they're smart people generally. They know how much to pay, how much not to pay. If you overcharge them, they will either not come or they will come and they will leave. So you want to give the best product, keep it $50 cheaper, keep it $100 cheaper. So you have stability in your life. The tenant stays there longer. You have good people that you deal with. So I use realtor.com. In terms of cash on cash returns, I would say if you're buying an independent house, you have to make minimum 10% because it costs a lot of money to maintain these properties. If you're an HOA, 5% and up is good. And in terms of how would you value the property, if you're buying a single family house by itself or a duplex, then 10 times your annual income. That's a good rate. But each area is different, so that's a good rate for most parts, but each area is different. That's why real estate, I keep saying, is very local, because you have to know your local area. And once you know your local area, you can be the Donald Trump of that area, because nobody would know more than you, and every time a deal comes in, you'll be the one who pounces on it and you'll be the one who makes money. So let's conclude this video. And what are the salient things that you need to keep in mind so you don't lose money, you always make money on property? Point one, don't be in a rush. Things will come your way. Things will happen. You just have to wait for the right deal to come across. Sometimes even when you find the right deal, the negotiations can take a long time. This property that I'm living in, it took me about 1 year to get the seller to my price. They were trying to get about $100,000 more than what I paid for. I paid $570. They were trying to get $670 out of this property, which I knew was overvalued. So I kept persisting. I told them how serious I was about the property, so they knew if they didn't find anybody else, I would buy it. And they didn't find anybody else because it was too overvalued, and eventually they sold it to me at $570. Point two, always make sure your property cash flows, because only then can your investment be safe. Each property has to be independent by itself. It should be self-financing. You should not be putting more money into it. Once in a while something big breaks down, that's okay, but not every month. Point three, the cap rate needs to be at least 3% above your interest rates. So if your interest rate is 4%, I would not buy a property which gives me a cap rate less than 7%. If your interest rate is 3%, I would not like to buy a property that gives me a cap rate below 6%. And never buy a property in which the cap rate is low and the interest rate is higher. That's a no-no. Point four, always buy in B and C class neighborhood. They give you the best value for money, the best tenants, very stable properties. Point five, always get a 30-year mortgage. Don't listen to Dave Ramsey. Always get a 30-year fixed rate mortgage. I'm going to make a video on mortgages, differences between 15 and 30-year mortgages, and why a 30-year mortgage is important and why it makes you more money. But for now, take my word. Always take a 30-year fixed rate mortgage. Point six, start with residential properties. Stay with the residential properties for a long time. The assessment is much simpler. At least initially, for first few properties, do not think about commercial properties. When you are a pro at investment, maybe then you can start looking at commercial properties, but not to begin with. To begin with, stick with a duplex, triplex, fourplex. If not them, then maybe a single family house, a small single family house, not a big one. If you buy a McMansion, you will financially be never independent in life. Life is over. You are chained to that job. You will be slave to your boss all your life. Alright guys, so in this lecture I told you about how to go about selecting a property, how to select the area, what is the acceptable rate of return, how much more should you make from your interest rate that you have. I would be coming out with a series on real estate investment, so you don't have to buy any courses like I told you earlier. Follow my series, listen to every word that I say. You will make money, your family will do good. See you in my next video. Goodbye for now.